If you spend enough time looking for financial advice online right now, you will inevitably hit a wall of panic. You are told that there is a quiet economic shift happening, a ticking clock counting down to 2026, and a mandatory list of assets you must buy before your cash completely melts away. The global economy does not operate on a cinematic countdown timer. There is no midnight deadline where fiat currency suddenly vanishes from your bank account. The real risk lies in letting manufactured fear push you into misallocating the limited capital you have right now. The blueprint pushed by these panic videos usually demands you instantly buy into 5 things: broad market index funds, real estate investment trusts, high-yield dividend ETFs, the cryptocurrency Bitcoin, and an online course to learn a new skill. When you strip away the marketing promises of 10,000% returns, you are left with a sober reality. You have to measure these purchases against your actual risk tolerance and your ability to generate income. Every single one of those 5 assets is a sound financial tool. However, they demand completely different resources to work and serve contradictory purposes. Building wealth is a process of sequencing. It requires looking closely at your current bank balance and choosing the specific vehicle that matches your stage of life, rather than trying to hoard everything at once. This quadrant chart lets us evaluate these assets by plotting them based on 2 constraints: how much cash you need to buy them, and how much time and effort they require to maintain. We start with the primary wealth anchor, broad market index funds like the S&P 500. When economic fear peaks and the news cycle is dominated by panic, investors historically accumulate shares of these massive corporate portfolios at a discount. The trade-off is significant. To see meaningful growth from a 10% average annual return, you must inject large, consistent amounts of capital and possess the emotional discipline to leave it alone for decades. High-yield dividend ETFs operate similarly. These funds pay out a slice of corporate profits every quarter, creating an advantage called yield on cost when you buy during market dips. Setting those dividends to automatically reinvest builds a compounding snowball of cash payouts over time. On our chart, both index funds and dividend ETFs sit in the top left. They are highly passive but demand high capital to be effective. These anchors provide reliable growth, but the math dictates that they sit idle if you do not have significant surplus cash from a primary income source to feed them. Other assets are marketed specifically as a defense against currency debasement. As central banks print trillions to service national debt, purchasing power drops. This environment drives the demand for alternative assets. Fractional real estate is one such option. Modern platforms now allow you to buy slices of commercial property or investment trusts for as little as $10. The mathematical reality is less appealing. The yield on a $10 real estate investment is measured in pennies. Buying fractional shares also removes the primary advantage of physical real estate, which is the ability to use bank leverage to multiply returns.
Bitcoin serves a different role. It operates on a hard-capped supply of exactly 21 million coins, meaning it cannot be diluted by central bank printing. It functions as a powerful asymmetric hedge, but it introduces extreme price volatility. Holding it requires a high tolerance for massive psychological drawdowns. Both REITs and Bitcoin land in the bottom left of our chart. You can enter these positions with very little money, though Bitcoin carries a severe risk warning for volatility. These assets can protect the purchasing power of the money you already have, but the low entry point is an illusion. Stacking fractional shares on a small budget will not generate primary wealth. This leaves the final outlier, high ROI self-education, which often promises 10,000% returns. The financial barrier to entry is nearly zero. It usually involves spending $50 on editing software or buying a single targeted course. The true cost is found in the labor. It requires exhaustive amounts of your personal time, intense focus, and aggressive execution to make that initial $50 translate into any return. If executed correctly, this asset actively multiplies your earning power, directly generating fresh monthly cash flow. However, the failure rate for learning a new skill is dramatically higher than holding an index fund. Without successful monetization, the return on investment is zero. Self-education lands in the bottom right of the chart. It requires almost no capital, but demands massive active effort. Self-education acts as the engine for creating wealth, rather than a vehicle for storing existing capital. Understanding these assets is only half the equation. The next step is matching them to your personal financial reality. This flowchart isolates your correct move based entirely on your current cash constraints. It begins with one question. Do you have more than $500 of discretionary income left over each month? If the answer is no, you fit the capital poor beginner profile. You are struggling to save extra cash. You should ignore fractional shares and dividend yields for now. Dedicate 100% of your available resources to self-education and acquiring a high-income skill until you fix your cash flow deficit. If your answer is yes, you likely fit the busy professional profile. You have high surplus cash from your career, but little free time for a side hustle. Avoid the distraction of active hustles. Deploy your surplus capital heavily into index funds and dividend ETFs, letting the broader market do the heavy lifting for you. Finally, we look at the risk-conscious optimizer. This is someone with secure foundations looking to protect their wealth from central bank policies. Once your foundational assets are secure, you can justify deploying capital into Bitcoin as a strictly capped 1 to 5% hedge against inflation. Financial success is dictated by sequencing the right asset at the right time. Buying a fraction of every asset at once only dilutes your progress. Reject the manufactured panic of the internet and ignore the ticking clocks. Evaluate your own cash flow, pick the tool that solves your immediate bottleneck, and invest according to your math.